Good morning. We are still just waiting for one or two guests to join us online, then we'll start. So just give me another minute. Good morning. I think it's about time to start and kick off this very short overview. Welcome to all our guests. I see there's some very familiar faces and names here, not necessarily faces, but names behind the scenes. So Chris, Lawrence, nice to see you joining us as well. So the objective of today is, as part of Adfinity's initiative to keep clients informed, is to bring in different guest speakers on an ongoing and ad hoc basis. Just from a compliancy point of view, I would like to confirm that we will be recording this session and it will be available on the Adfinity YouTube channel. It will also be sent out within the next week to all clients to be on your cell phone or on your laptops. We also obviously regard your personal information as protecting that information we take it in a very serious light, and we'd like to confirm that we will not disclose any of your personal information to any third party, and that we will comply with the proper regulations. And the second thing is that this recording will only be distributed to our clients and other parties. I want to welcome Leslie to the screen. I was thinking about the introduction this morning, saying three wise men, but that's not true because there's two wise ladies in the audience this morning. And I really want to welcome Leslie. Leslie is the key account manager of Nedgroup Investments. She's been doing some great work with us, interacting with the Adfinity team, attending several workshops and informal nice functions. So thank you for joining us today. And she will be introducing Natalie to you. That will be our guest speaker today. So thank you very much, Leslie. Over to you.
Good morning, everybody, and good morning to Johan and the Adfinity team. Thank you so much for asking us to present today. We're really honored, and thank you for all of your continuous support.
Leslie, since we can't pick you up now, we just want to make sure that your mic is on.
Oh dear, yes.
It is on, I can hear.
Okay, can you hear me? Nats, can you hear me?
Yes, I can.
Sorry. So yes, thank you so much for hosting us and for your support. I'd just like to introduce Natalie. Natalie is a senior analyst in our Best of Breed team, and she is responsible for looking after our global flexible fund, which a lot of you are invested in, and she's going to take us through
a problem hearing you. Natalie, can we double check if your mic is operational?
I can hear Leslie. I'm not sure.
So can I. I think the trouble's on your side, Johan.
Yeah.
Everything's fine for me.
Can you possibly hear me now, Johan? Johan, can you hear me now?
Yes, we can hear you now, loud and clear.
Fantastic. introduce Natalie quickly. She is a senior analyst in our best of breed team at Nedgroup Investments. Natalie is responsible for our global flexible fund, which is a fund that Adfinity used to a large extent, and I think a lot of you will be invested in. And that's just going to take us through sort of a macroeconomic overview, especially with all the turmoil that's going on at the moment. Quite an interesting time, as well as a little bit about the fund. Nats has an honors in finance as well as a CFA degree. She's got, although she looks very young, has about 10 years investment experience. She's been with Nedgroup for 2 years and was at Prescient Asset Management before this. So Nats, over to you. Take us away. Give us some insights and calm the nerves. Thank you.
Thanks, Liz. So everyone can hear me fine?
That's fine, thank you.
Okay, great. Sorry, just quickly looking to share my screen. Yeah. Can everyone see this?
100%, thank you.
Okay, awesome. Thank you so much for having me today, everyone. I really appreciate the time. And it's really great to be able to come and talk to you about what's happening in the market at the moment and just give you an update on the Global Flexible Fund. So starting by looking at the performance of SA asset classes, this is to the end of March 2025. So what's been driving the market over the last year? So we've had a really strong year across all SA asset classes. And these recent returns, if you look at that long-term average, you can see these last 1 year returns have been well above the long-term averages of these asset classes. And what's really important to note is that we won't always have periods like this. There will be some negative 1 year periods as well. So let's just chat about SA equities and SA bonds first. So pre-2024, pre-elections and GNU, SA equities were really pricing in quite negative outcomes. There was a lot of pessimism in our markets. And then we had our election, and it really gave South Africa quite an uptick. And with the formation of the GNU, it gave it another boost. So on a forward-looking view, the market is really a lot more optimistic about SA equities and the future earnings of our South African companies. So we can see that in how SA-listed companies with a large component of offshore earnings didn't actually do as well as companies that have a pure SA-focused revenue stream. So SA prospects have become a lot more positive and ratings and price earnings went up. But going forward, what we really need to see for this asset class to keep performing well will be that the earnings of the companies really start to come through. SA bonds have had an absolutely fantastic year. We had the GNU and the positive sentiment and yields came down, which drives bond prices up. And basically, a component of bond yields is our country risk premium. So this is what investors want to be paid in order to invest in South Africa with the associated risk. So in the case of the formation of the GNU, the risks associated with South Africa appear to decline. So our country risk premium compressed and yields went down, so bond prices went up. SA property is an asset class that has very similar characteristics to equities and bonds. It has that capital component and that yield component. So for the same reasons as I've mentioned for equities and bonds, SA property also had a phenomenal year. And then in terms of cash, we had zero interest rates after COVID normalizing. So cash has given us better than historic returns. And obviously, because cash is directly linked to our repo rates, which has been on the higher side, it has done well. But we've started to see the SARB cutting, so cash rates probably will be a bit lower going forward. And then SA inflation has been relatively benign over the last year. That's partly because of the rand being quite strong. So a lot of our imported goods become more cost effective for us, and oil prices have been more relaxed. Then just looking quickly at global asset classes, if we look at global equities, in 2024, so for the year up to December 2024, global equities posted nearly 20%. And this was led by the US and China. and mostly also from the tech sector with all the companies in AI, which drove quite significant gains. But in Feb this year, we saw a very sharp pullback, and this was around concerns over rising interest rates and inflation, geopolitical tensions, and this really led to a shift in investor sentiment. So everyone started getting a little bit nervous. Global property has not performed as well as it has in terms of its long-term average. And this is basically around high interest rates, which negatively impact property as an asset class because it increased their borrowing costs and their discount rates, which then affects their profit margins and their market values. Global bonds saw positive returns. This was also led by US Treasuries as markets feared a recession and bond yields fell. And this is true to most jurisdictions in the world. We saw bond prices falling over the last year. Cash in the US has been performing pretty well, and inflation in the US, as you know, has been very sticky, but it's good to see it finally starting to come down. So there's been a lot of noise and uncertainty in the markets at the moment caused by Trump and his tariffs. So let's just look back on how it's all unfolded thus far. So the 2nd of April was what we call Liberation Day. And this is where Trump announced his sweeping reciprocal tariffs across nearly all products imported into the US from almost all countries. So this move was part of his strategy to reduce the US trade deficit and boost domestic manufacturing and exports. So the initial tariff imposed was a 10% minimum duty on imports across all major trading platforms, major trading partners, with additional tariffs imposed on many countries who had a large deficit with the US. So this means that the US was importing more from these countries than they were exporting to these countries. So the market reacted very, very badly to this news. And this is despite tariffs not being anything new, because Trump has actually been talking about these tariffs for a while. It was part of his election campaign, but the market seemed complacent about it. And maybe this was actually about the imposition and the extent of the tariffs, but they definitely weren't pricing it in, and they got a big shock when he actually announced them. So the 5th of April, this is when tariffs were set to take effect, and that was tariffs on cars, which was about 25%, and other goods, and these ranged from 11% to 50%, and that was for 57 targeted countries. Including this was a 30% tariff on South Africa and also 30% tariff on China. So then 9th of April, Trump abruptly pauses these tariffs for 90 days. And this is, we're assuming, because he did receive significant backlash from businesses and economists who argued that the tariffs would harm the US economy. And then we saw on the 11th of April, this kind of tit for tat with the US and China. It just continued. So the US initially imposed a 30% tariff on China, then China retaliated with 25%, then the US increased to 54%, then China to 34%, then the US to 104%, China to 84%, and now we have the US with 145% on China, and China with 125% tariff on the US. So this is just huge. This escalating trade tensions between these two countries has really caused a lot of market volatility because these are the two largest economies in the world. So it's really, we're not sure what's going to happen next. The situation is very fluid and evolves on a daily basis. But what we do know is that the market is not happy with the tariffs and the uncertainty. So if we look at the MSCI World Index, so this is the global equity market, we can see that super sharp sell-off in March after the tariffs were announced, and the market lost about 10% over that time. And then we can see where Trump announces the pause in tariffs, how the market bounces back. So if you look at the returns over the short term, and this is just a one-year chart, especially if the returns have been very volatile, it does look really bad. But we have to remember that equity investing is meant for the longer term. And over the long term, our volatility smooths out and we will benefit from being invested in equities. So basically, if we take a big step back and we look at the world the global equity market over the last 25 years, we can see that despite the volatility experienced at the time, which was in some cases very high, equity markets have always recovered. We can see at the end of this chart, the latest market dip is actually so small in the grand scheme of things. So we don't have any reason to believe at this point that the market won't recover and continue as it has in this chart. You know, companies will continue to make goods that people need to buy and provide the services that we need to use. And the fundamentals of the companies are still really good. So this is just a short-term overreaction to news, and the market does not like uncertainty. And yes, there will be companies that will go out of business and companies that will do really well. But on average, if you have a diversified portfolio, you will definitely benefit from owning equities during this time. So just a brief look at what's happening then in Europe and China. So Europe is finally experiencing some tailwinds. Even though the ongoing US trade war is causing negative effects for them, there's still some positive developments that will help boost growth in the Eurozone. So the German parliament just passed a new reform, which it allows them to spend more on defense. And they've also just done a 500 billion euro stimulus package to improve their infrastructure. So all of this adds together to about €1 trillion over the next 12 years that they'll be injecting into the economy. And this could potentially boost Germany's GDP by 1 to 2% each year. So it's quite significant. Then we also have energy prices in the Eurozone dropping, which will really contribute to consumer spending, which we're seeing bounce back from these lows as their personal finances are quite healthy. Then just looking at China, China's planning to increase its budget deficit this year to boost economic growth. So they're going to take on more debt and stimulate the economy through the fiscus. There's still uncertainty about whether these measures will actually get the consumer to spend more. But if it doesn't, they're going to roll out a subsidy program to encourage spending. So if by the second half of this year, the spending hasn't picked up, then they'll roll out the second program. So even with these positive steps, obviously the trade war with the US and China is still a big concern. And China has been trying to reduce its reliance on the US market. So they've been diversifying their trade relationships. But just seeing this latest battle and how hard Chinese stocks have been hit, it just shows how vulnerable the market is to geopolitical issues. So how does it affect us then here in South Africa? So we basically export a few key products to the US. So this is our vehicles, which is a significant part of our trade with the US. We then also export minerals. You know, we're a commodity heavy country, so we export a lot of platinum, gold, and other precious metals. We also do agriculture, so our citrus fruits, nuts, and wine. And then we also do aluminium and iron or steel products, so metals. So our biggest exports in South Africa are actually commodities. So if you look at that chart on the right, you can see that of our total exports, about 55 to 60% of these are actually commodities. So from our economy perspective, we're actually most exposed to economies that import commodities from us. And this is not actually the US, this is actually Europe. The direct impact of the tariffs is actually limited to our non-commodity exports to the US. So this is primarily cars and agriculture. And this only represents about 0.6% of our total GDP. So it's not a significant impact at all. What is concerning and what we need to watch out for in South Africa is the secondary effects from slowing global growth that the tariffs will bring. So this could hurt our tourism and commodity demand. But ultimately, our relationship with the US and our ability to maintain our GNU is going to be of more importance to our economic outlook than the actual tariffs. And then just looking at the broader economy, we can see the JSE there and how it's taken a little dip around all this uncertainty lately. But South Africa's economy is facing some serious challenges. Growth might be slower and take longer than expected. if we do get a big global slowdown from tariffs hitting everyone, our growth forecast will also be lowered because of it. We've already got low consumer and business confidence because of our delayed budget and instability in the GNU. And negotiations may look like there's a resolution coming soon, but political stability is still a big concern. And if we have worsening SA-US relations, this could be a risk to us. And we've already seen it in our domestic companies having their stocks sell off because of political uncertainty. In terms of inflation, it's not a big issue for us from the demand side, but if we do have a weakening rand, as we have seen in the last couple of weeks, this could cause supply side inflation. But if we have falling oil prices, it should be able to help us out there. And then in terms of interest rates, if inflation stays in check, you would expect that we'd be able to cut rates, but we've had 3 consecutive cuts, and at our last meeting with the MPC, they chose to pause rate cuts, and this was around ongoing global uncertainty and domestic issues. So the SARB is very cautious. They're going to take a cautious stance here, and they're definitely not. So what does it mean for all of us as investors? Financial markets at the moment are an absolute roller coaster, and this is nothing new. We have to be able to sit through the difficult periods, to be able to benefit from the good returns that we can achieve over the long term. So as we go through ups and downs, our human nature often leads us to be fearful or greedy. So at the moment, we're obviously all really fearful. And often it ends up being at the exact wrong time in the market cycle, which hurts our returns and means we're not successful at achieving our investment goals. This chart summarizes investment outcomes really nicely. So it's basically showing the average stock return versus the average return of the investor who actually bought the stock. So often people talk about the costs that they're paying for their investments, which is obviously a really important thing to scrutinize, but the hidden cost of making bad investment decisions or trying to time the market and getting it wrong is actually a bigger cost that investors face in achieving their overall goals. Because for one, we tend not to save enough in the first place, and then we don't commit enough capital to our investments. In addition, the combination of our emotional decision-making all the time is almost a guaranteed formula for poorer investment outcomes. So yes, there's a lot of uncertainty and the equity market is very volatile, but with that volatility comes many days where returns are strongly positive, and people underestimate how instrumental those relatively few days are in terms of delivering successful investment outcomes. So you need to remain invested to benefit from the really strong positive days. If you look at this chart, we can see that if you missed the 5 best days, you would have earned 240%, the 5 best days in the market. You would have earned 240% versus 366% if you stayed invested. So that's almost a quarter of your total return that you lost just from missing the 5 best days. If you missed the 30 best days, your total return would drop to only 15% over return. People get scared when the market falls, but actually after the market falls is when some of the best returns are to be had. So as we've seen, the long-term returns for SA equities on average were about 12.5%. So as you can see in this chart, the returns you achieve after investing, the returns you achieve from investing after the market falls dramatically, those returns actually significantly higher than long-term averages. Yet these are exactly the times when investors are wanting to move into cash or disinvest completely. So even if you stayed invested and held on for longer periods, you'd still get a better return than that average result of 12.5%. The whole point of this is that you're already invested and you have already experienced the fall. You've been a part of the market during the crash. So why not just stay invested and experience those better returns after the fact? And if you had excess capital to invest at these low points, that would be an absolute brilliant time to do it. So this is just a great chart of basically showing what happens if you disinvest after the crash. So if you did move into cash at the worst part in all of these different market crashes, like for example, the day that Trump announced the tariffs, these are periods when anxiety levels are high, and it does seem like a safe option to disinvest. But looking back on history, it's clearly the wrong time to have done so, because the end investment outcome would have been much worse. And a further complication would be having to buy back into the market. So then you end up buying in at a higher price, which means you've lost out twice. So you've lost out on the really good returns that you usually get after the period of the crash. And you're losing out on future returns because they're lower, because your starting point is higher, because you bought in at a higher price. So it really is a double whammy. So looking at different asset classes over time, we can see that their performance differs from year to year. There's no one asset class that consistently performs well or provides strong returns. And this is because asset classes respond differently to different economic factors. So if you can diversify your portfolio, it means that you can get a stronger return journey as opposed to just being invested in one specific asset class. And the temptation as a human is always to be envious of which asset class was the best performer, but this is always in hindsight. So for example, if you were to look at global bonds, which in 2020 was actually one of the best performing asset classes at 16.7%, after that year, you may think, wow, global bonds are the absolute best place to be. Let's invest there. But then if you look at 2021, global bonds were the worst performing asset class. So looking at the balanced portfolio, which is the yellow, and that's where the line is, we can see that a diversified mix of asset classes, as volatile as that even may still look, is still smoother than investing in single asset classes. So to achieve really great long-term returns, you do need exposure to those volatile asset classes, but the balanced portfolio will give you access to more stable asset classes like cash, which also lets you sleep a little bit better at night. The Nedgroup Investments Global Flexible Fund is a great example of a diversified portfolio. So just a quick recap on what the fund does. So the fund's trying to provide equity-like returns without taking on as much risk as the equity market. So there's strong focus on protecting capital. In this fund, we actually define risk as permanent capital impairment. So we absolutely do not want to lose money. It follows a value style. So value is defined as not paying more for something than what we think it's worth. And it's a fully flexible fund. So it can invest in any asset class, any geography. So it's a globally diversified portfolio. And the team performs really deep investment research to understand the companies, because that's how you minimize the risk. If you ask yourself, what can go wrong here before you invest, you've considered every possible scenario. They're looking for the best absolute opportunities that they can find. So just a quick look at the performance. I've got the US dollar performance and the feeder fund performance in rands. So the dollar performance, the fund declined 1.2% for the quarter, but is up 5.6% over the last 12 months, which is basically in line with the benchmark. More importantly, if we focus on the longer time periods, which we should do as we need to have a long-term mindset when we are invested in equities, the fund is ahead of its benchmark for most of the periods. Over the last 5 years, the fund has outperformed the benchmark by 3.3% per annum. And looking at the feeder fund performance, it's a similar story. The fund has very comfortably outperformed its peer group since inception. And looking at the longer term again, the performance is really strong. And what's important to note is we believe these results have been achieved without exposing investors to meaningful risk or permanent capital impairment. So over the past 12 months, there weren't actually any significant news events driving the top performers higher or the bottom performers lower. For example, Global Flex's top 5 contributors contributed 3.2% to its return. So those were companies like Jefferies, Wholesome, Meta, Kinder Morgan, and Wells Fargo. And there wasn't actually anything specific that drove these returns. They are just really good, great quality companies, and we expect their future earnings to be good. Same goes for bottom 5 performers, which include Comcast, Glencore, Icon, Ferguson, and LG Corp. These contributed 1.7% to the losses over the last year. And when we buy companies, we're looking for bad news or some level of misunderstanding about their long-term prospects, because then it lets us get these companies at a really good price. So we hold these stocks for long periods, and as long as their investment thesis and their stories remain intact and they don't become too expensive, we will keep them. So a really great example is Glencore. It's a commodity company, one of the largest in the world. And people are quite uncertain about commodities at the moment. But the CEO has recently bought another 1% of the stock. So they've now increased, he's now increased his ownership to 10%. So if management is seeing value, clearly there is something great there. So yeah, these are just really great quality companies that we expect to continue to do well into the future. Looking at the portfolio now, we've got about 55% in equities, 2% in bonds, and 43% in cash. So the lower equity exposure is not so much driven by any top-down views on the market, but rather is a result of security analysis, so looking at the companies from a bottom-up basis. So we've had years of very strong back-to-back performance in the market. And because of this, we then either trimmed or exited names where their future returns were looking like there wasn't as much upside anymore. So it warranted reducing the position sizing. What's really important to note with the Global Flexible Fund is that the liquidity or the cash position in the fund is going to be an excellent buffer to portfolio impacts during periods of market volatility and corrections. So this is really going to assist the fund in moving through these uncertain times. It also really gives us the flexibility to quickly move into new positions if any really great opportunities arise. So just to look at the equity positioning, so the portfolio is globally diversified. So this helps mitigate risks from any single country or sector. So the most prominent risk exposure in terms of the equity allocations is still communication services at 12.2%. To highlight a few sectors that may be impacted by the tariffs, so the exposure to communication services and tech-adjacent businesses could be affected, as they could potentially be forced to endure higher hardware costs, or there could be retaliatory actions from foreign governments. Ad revenue could be impacted, or their market access. Financial services firms like Citigroup there may be exposed because of macroeconomic risks or currency fluctuations. There's a lot of potential things that could happen, but we're not making any large-scale changes to positioning because of the market's immediate reaction to tariff announcements. So over the past couple of quarters, we've continued reducing companies that are looking expensive and moving this capital into companies that are well-priced with strong franchises and enduring business models. And I'm sure you recognize a lot of the names there in the top 10. Alphabet owns Google, so even with they had a 17% decline in Feb, but even with this, they have really strong revenue growth off the back of their ad divisions. Meta platforms, everyone uses Facebook. They've been spending a lot on AI. It's a big focus for them. We're also invested in Wholesome, which is a building materials company. And Comcast, you may recognize some of the brands. They own Sky Sports and CNBC. But actually, one of the strengths of this business lies in they do broadband as well. So they do core cable and fiber infrastructure. And it's actually one of the most valuable assets of the company. So the top 10 makes up 25% of the fund, but it is a broad diversified mix of companies. So looking at the revenue split of the equities in the fund. So this is where the companies derive their revenue from, not where they're actually. We can see fund from this. There's 49% in North America, 5% South America, 21% in Europe, 4% Africa, and 21% in Asia. So in terms of how we view the world and how we manage this fund, where a company is domiciled is the quality of the business and the price that it trades. So if we examine the composition of the companies, we can see that they derive more than half of their sales from outside of the US. And what's really great about the mandate of this fund is that it allows us to invest more broadly. Because of the flexibility, it gives us the opportunity to invest in other parts of the globe, which are much less expensive than the United States at the moment. So what are we doing in the fund to handle the uncertainty? So there has been a lot of analysis on the implications of the tariffs by many talented investment professionals. But the last time tariffs were introduced at this magnitude was over a century ago, and certainly not on the global scale that we're seeing today. So no one knows what's going to happen. All we can do is lean into the 30-year investment framework that we have, and the team that manages this fund, FPA, their deep experience in navigating crises and market cycles. So we are reinforcing our process. We are prioritizing business quality, making sure that the companies that we're invested in continue to be durable, that they have a strong competitive position, a good chance of growth, management teams that we trust, and balance sheets that are durable and strong enough to get through whatever may come. So before we invest in a company, we review it on a low case, a base case, and a high case. And this is really where risk management comes in. So understanding the low case and what drives that company is really fundamental to ensuring you manage risk properly. On a day-to-day basis, the names in the portfolio may be impacted by different macro concerns, but as investors, we need to think about investments on a 3 to 5 year time horizon. So we want to ensure that we have a good understanding of the range of outcomes, particularly in the low case. So we really need to ask ourselves, what is the worst that could happen? And this type of scenario analysis is made before we invest, and it's done throughout holding the investment to make sure that we avoid ugly surprises and ensuring the stock remains a fit in terms of what we're looking for with those quality companies. And if you choose companies this way, you should end up with a portfolio of really great quality companies with durable businesses and great future earnings that can then withstand the short-term market volatility and uncertainty that we're seeing. These businesses should be able to weather the storm. And then finding opportunities. The team is actually really excited about what's going on in the market at the moment because it means that we're getting short-term mispricing. And some of the companies on the watch list, which is basically a number of companies that we look at that we would love to hold, but we're patient in waiting for the price to become right. Some of those companies on the watch list actually now become affordable and we can buy them. So there's a lot of opportunities that could arise from these types of market situations. Is there anything to buy though? Valuations are still quite high. Companies are still looking quite expensive, and despite the sell-off, valuations haven't actually fallen yet. So we have increased some of the positions that we hold if the stock took a little dip and became more affordable. But at this point, we're still waiting to look for those really great opportunities and really good prices. So all of the news is definitely very unsettling at the moment, but the investment approach centers on durability and investing in companies with financial strength and a long-term focus over full market cycles. So we are closely monitoring developments and working to look at the range of potential outcomes with the goal to drive performance for you, our clients. So what's next? The only certainty at the moment is uncertainty. So as investors, we can't actually do anything about what is happening now. And we certainly can't predict the future. But we need a portfolio that is set up to match our risk profile and goals. So it's too late to react now. And what we've seen is that if we do react now, it will most likely cause harm. It's actually more important to just have a portfolio that's diversified and just sit tight and weather the storm. It's actually not possible to set up a portfolio that's immune to tariffs or anything. You know, we'll never know what the next catalyst will be that's going to cause market volatility or affect our investment and make it involved. Is that when markets are expensive, there's more anxiety around making sure everything goes right because we're priced for success. But this actually can lead to failure. Whereas when things are bad, your downside is limited because of how much markets have already taken a step back. So this is the time when forward-looking returns are actually looking super attractive. You know, it's the age-old thing of buying low and selling high to make money in investments. So if your money is already invested, you can rest assured that our fund managers are making sure that they're continually assessing what's happening in the markets locally and globally, and they're adjusting their portfolios accordingly. As a client, your responsibility is to make sure that you're aligned with your financial advisors and you're in the right funds. And by right, it means the funds that will maximize your probability of success of meeting your investment goals, but also allowing you to sleep comfortably enough at night. Thank you.
Thank you very much for your most informative session. I wish we had time for questions. Unfortunately, we all have to go back and see our clients now. Just for those clients that joined the team or the presentation a bit later, we will be sending out a copy of this recording via our Adfinity Financial Services YouTube channel. And once again, Natalie, thank you for your insights, and Leslie for putting this together for us. We're looking forward to a follow-up session in the near future.
Thank you so much for having me. Thank
you, Nat, and thank you, Adfinity team. Really appreciate you having us. And yeah, I think that was very insightful. Appreciate it, and we look forward to engaging again soon.
Please let us know if you have any questions. We can just chat about it if you have time afterwards at another date, I mean. Oh, you're on mute.
Thank you for everyone attending the workshop, and we're looking to host our next one pretty soon. Thank you.